And if I had a certain amount of equity, they were going to give me an interest-only loan at 3.125%, which is a really, really it's a big improvement on my cash flow by $1,000 per month, which I could then put that money to work. So, so it really depends on the fees, how long you're going to stay there, if you can refinance other things while you're doing this. But it is definitely a time to be looking into this.
Yeah.
Money can be complicated. Let a nerd help you. We're here to demystify the complex nature of money by getting you answers from financial nerds and whiz kids. Welcome to Ask the Money Nerds, a weekly segment of the Wealth Labs podcast where we answer your most pressing money questions. Is now a good time to refinance with this interest rate so low, and are the fees worth it? And at what point would you break even? Are there lower cost options, and when does it make sense to make this move? Stolba, what's up?
Hey there. You know what I was thinking about?
No, but I'm sure you're about to tell me.
I want to get your thought. I want to know what your pet peeve is. I have one that comes to mind that I'll share, but I want to know what your pet peeve is.
Do I just get one? The problem is I've got like inefficient things that are very inefficient tend to trigger me. So,
like an example would be what?
Like here's a stupid one, but my wife can predict what I'm thinking when I'm at a street light and it's taking like 2 minutes. There's not any traffic coming the other way.
Yeah.
And she's like, you want to run the light, don't you? I'm like, I should. This is stupid. You know, it's just so inefficient. I'm like, it's 2020 and we don't have that figured out yet.
Yeah.
That seems absurd to me. Right? How about you?
I remember driving in the car with you and you didn't run any red lights, but you were like cutting through gas station parking lots and just like trying to find the shortest route. I felt like I was in Mario Kart, but we got there a lot faster than if we would have just sat and waited for all the lights.
So last year I took my family on a trip, meaning like my siblings and my parents, and my sister and I wrote these 3x5 cards with questions. And one of the ones she wrote on there is, what's your pet peeve? And my dad's like, I don't know if I have one. And then like the drive was 3.5 hours and he kept coming up with new and more stuff, just constantly. I'm like, is this
a long list now?
Peeve or peeves, like plural. So yeah, but inefficiency is what really triggers me.
Mine for today is, because I have many, but when I am emailing people and they just add me to their list.
I've seen
You've
that
heard
happen
me.
to you.
You've seen me when I'm like, I didn't ask to opt into your list. You just added me because you got my email address off of LinkedIn or wherever it was. And now you're asking me to reply to the email that says I opt out when I didn't even opt in to begin with. Oh, it's so, as you can tell, my energy is changing. It's very irritating to me. Like, I want to opt in and maybe even double opt in to what you're offering me. Don't just include me in whatever you want to build your email list.
Well, I've never opted you in.
No, you haven't.
No.
Thank you.
Yeah.
And shout out to everybody who has never done that. Thank you so much. So we have a question from Damon today.
Okay.
And this is what he says. Everyone I know is refinancing their mortgage. True. I know a lot of people who are doing the same thing. My neighborhood has done theirs twice, or my neighborhood. Let me start that over. Let me start that over.
The whole neighborhood is refinanced. Everybody in the hood.
The whole This happened to me last session where I was just jumbling my words, but I had an excuse for it then, not today. Okay.
Because you're drinking whiskey? Because I was smoking tobacco and you're getting that nicotine high?
Yeah, I guess so. Second high. Okay.
People looking out for you when I smoke those tobacco pipes get really angry.
That's true. Mm-hmm. All right. Okay. Let's give this a second attempt here. So Damon's question: everyone I know is refinancing their mortgage. My neighbor has done theirs twice, but I can't think that with these fees and points that is a good deal. I mean, they did it once, so you have to assume the rate on the first refi was decent. So how much can they be saving? Are people not looking at the whole picture of the total cost and fees when doing this? I can't help but thinking we're getting screwed. What do you think about this?
All right. So here's the thing. When you're getting a mortgage, there's front end points and back end points.
What's the difference between the two?
So front end points are a percentage of the overall loan that you pay. And a lot of times that could be included in the loan, or you might pay it out of pocket. Most of the time it's included in the loan. Back end points are money that goes back to the mortgage brokers based upon the interest rate that you have. So if you have a higher interest rate, they could be getting back end points. But some people are like, oh, this is a no fee mortgage, which means no front end points, but it might be a little bit higher interest rate. So you kind of have to measure that, right?
Is that information they will share with you freely, or do you have to go digging for that?
I don't know. I used to have a mortgage license, and I can't even remember, but I know about back end points. You can just look at what is it the most competitive interest rate? Front end, you're going to see it's right there on that front page disclosure.
Okay.
What your front end points are, what your additional fees might be, right? Like appraisal and title insurance and all those kind of things. It's usually a 1-page summary. That one's super simple to get through.
Yeah.
But what I'd look at is a Streamline refinance.
Okay.
So a Streamline is you're going to stay with the same mortgage company, but if you have a substantial change in interest rates, they might be willing to lower your interest rate with a drive-by appraisal versus a full appraisal, with just a few pages of documentation versus a full kind of rehash, and with just a reduced fees or no fees at all. It depends on the company that you're with.
When is a good time to consider a Streamline refinance?
Right now? I mean, just you find out if you can do it. That's the key. It depends on the institution, and it might be, have you been paying on time? Do you have equity? Do you have a good credit score? They might have certain criteria, and they also just have to be willing to do that. And part of the reason they would be willing to do that is because they know so many people are refinancing. So if you refinance and move out, then they lose all that versus lowering the interest rate and keeping you as a customer. So, it's a lot less expensive to keep a customer than it is to acquire a new customer. So that's why it might make sense. That's not guaranteed that that's going to happen. So the next thing we want to look at is, if you're going to refinance, some things that might make a refinance worth it. And look, I got to give a big caveat here, because bad behavior destroys what I'm about to teach.
Okay.
But if you set up what I would call a wealth capture account, where when you free up this money, you're going to set the money aside into a checking, money market, or savings to build your peace of mind fund and have some liquidity, or you're going to look into cash flow banking and start allocating money there. As long as it doesn't get victim to Parkinson's law when it comes to money, which is, if you all of a sudden free up a bunch of cash flow, a lot of times people increase their expenses with that, and then you end up,
easy to do.
You might be worse off. But if you are to refinance and you have equity, you might find you can refinance and pay off credit cards that are much, much higher interest rates, or pay off lines of credit or student loans or other loans that are going to be charged at a higher rate than what your mortgage might be, and non-tax deductible, which your mortgage might be able to be tax deductible. So that's something that could definitely make it worth it. And all we got to look at is, what are you paying in interest on all your loans? And what is the new payment or new interest versus the old interest, and then the fees? And what you're going to find out is, what's your break-even point? Does it take 6 months before you cover all the fees of that if you just do a traditional refinance? Or does it take 8 months? Or does it take 1 year? And how long are you going to stay in that home? So for me, I'm in process of a refinance, which has been a very nice, frustrating process, because first off, I live on a street that's a nice street, but the reality is it's extraordinarily become nice. It's just exponentially become nicer since I've lived there, not because of me, but because all these houses on the street have been torn down and rebuilt. So all but like 2 houses on that entire street are brand new, amazing houses, but there's no houses for sale on that street. There hasn't been any houses for sale other than the old houses that got torn down, right? So there's no comparables. So my house right now, the realtors say I could sell it for $500,000 more than what it just appraised for. And so what we're having a problem with is, based upon the appraisals, if I refinance, I'm only at 80%, 82%, of the total value in loan, which means I'd now have to pay private mortgage insurance because of that 2%. So like, well, if you put $30,000 down, then I'm like, I'm not going to tie up 30 grand when I'm already at a competitive interest rate. And if I had a certain amount of equity, they were going to give me an interest only loan at 3.125%, which is a really, really it's a big improvement on my cash flow by thousands of dollars per month, which I could then put that money to work. So, so it really depends on the fees, how long you're going to stay there, if you can refinance other things while you're doing this, but it is definitely a time to be looking into this.
Yeah.
I mean, and you can look at that disclosure page. So that's going to tell you the story. That one piece of paper is really going to tell you the story. The thing that you're not going to know for sure is, are you getting the most competitive interest rate? Are they getting back end points? Because I used to know a firm that taught how to get a 5-point mortgage, meaning if they were to help someone finance $1 million loan, they'd get 50 grand because they're getting so much on the back end points.
Right.
2 points up front, 3 points on the back end. which means that the interest rates were being pushed up, but it was back in the days where you can get adjustable rates at really low interest rates. They were even doing something called negative amortization loans. Have you ever heard of a negative amortization?
Just from you a little bit, which doesn't seem like a great thing.
Yeah, there's a thing called an option arm. So an arm is an adjustable rate mortgage, which that rate adjusts maybe from month to month, year to year, depending on what it's tied to, depends on how often that loan would adjust. But an option arm could say, oh, well, I want to make a 15-year payment, or I want to make a 30-year payment, or I want to make an interest-only payment, or I want to pay less than what is actually being charged, and then they'll just add it to the balance. That's what negative amortization is. And a lot of people before 2008 were like, oh, cool, I'll do that. And then the problem is that equity went away, and now people were upside down, where they owed more than the home was worth, but a lot of people were trying to be investors. The problem is they were investing in very speculative things, and everybody thought real estate was only going to go up, and a lot of people we saw in 2008, 2009, 2010 went bankrupt, lost tons of money, and so that's something to be really careful with. So
would you encourage people to avoid those negative loans?
I don't even know how popular they are, if they're even available these days, because there was definitely problems back in the day.
It's not necessarily something they need to be on the lookout for.
I haven't even heard about them in years. So
yeah, and I think one of the things that you were saying, if we kind of want to bridge the gap between other content that we've shared, is people can do the same thing with their mortgage loans as they can do with refinancing their car. You've talked about refinancing your car to then pay off higher interest rates on credit cards and other things to save money and increase your cash flow, and people can utilize their mortgage to do the same thing.
Right. So the concern is if you refinanced your home and you paid off some credit cards or other loans, that now you're going to have a lower payment, but you might have a longer period of time that you now have to pay on the loan, right? Because a lot of mortgages are 15 years or 30 years or interest only. And maybe your other loans might be 5 years or 7 years or something like that.
Yeah.
And so that's why if you're going to do it, you got to ask yourself, will you create an automated structure to set that money aside? And here's the deal. Most people are going to argue and say, people aren't responsible enough to do that. Well, guess what? If you're not responsible enough to do that, these other things aren't going to help you either, right? So that's kind of like, I don't like that we've kind of got to a place where we just take it to the most lowest common denominator of laziness, or lowest common denominator of discipline, or lowest common denominator like, oh, well, people won't save that difference. I'm like, well, if they won't save that difference, a 15-year mortgage can be dangerous for them, because now they're forced into a higher payment. And if they're reckless with all their other spending, and now they got 22% interest rate credit cards, they're going backwards. And so I get it, but the reality is, from an economic standpoint, refinancing higher interest rate loans and lower interest rate loans, lengthening those loans so that you have more cash flow to start building up liquidity and your savings, and start, making intelligent decisions, which I would say, if you don't go and start investing in the stock market, don't go and start investing in, speculative things or options trading or this kind of stuff. It would need to be stable and secure so that money's there if you do want to pay off your home, because the American psyche, or just the psyche of most people around mortgages, is if I have a 30-year mortgage, it means I have to pay on that for 30 years. That's not true unless you have a hard prepayment penalty. A hard prepayment penalty would say, hey, you can't refinance this or pay this off without triggering some types of costs, which sometimes they're doing that because of the back end points that they've paid a broker or something. So what you want to do is know that if you've got that money set aside, you could always pay that off in one fell swoop when you've got enough cash on hand. Having that cash on hand means that you now have safety if there's cash flow crunches, pandemics, economic turmoil. You now have cash to make a lower payment, and you've got cash set aside. So my thing is, keep control of your money and manage your cash flow where you minimize the outgo and maximize what you can set aside, but don't speculate with it. Because if we go back to 2008, a lot of people put it in the stock market and a lot of people put it into real estate, and both of those things got hammered for several years. And so people now had a loan with an asset that didn't even cover it. And then they lost their money that they had pulled out of it, by refinancing. So
I have two questions. So the penalty that, remind me the verbiage that you used, the penalty payment, what was that?
There's soft prepayment penalties, which are when you can actually pay it off if you want. And a hard prepayment penalty, you can't pay it off or refinance it. So without triggering a fee.
Is that determined by someone's credit score when they apply for the loan?
Not as much. It's more about the back end points that I'm talking about here. Okay. It's kind of like So sometimes people do annuities with their money, and annuities, you make a deposit into those, but a lot of times those have surrender charges. That I've seen them that go 15 years, Stolba, 15 years, where it might be like 10% in the first year and 9% for the next couple of years, and then 8, 7, and it's like, and those go down because they pay a really big commission to the agent a lot of times.
Yikes.
And so those surrender charges kind of protect the company's profitability so that people have to stick with it. And they might say, oh, you can withdraw 10% without triggering these penalties and those kind of things. But it's a similar type of structure with these mortgages that usually if you have a prepayment penalty, a lot of it has to do with the back end points. Not always, but that's a big part of the reason why you might have a prepayment penalty.
Okay.
Again, I don't see a lot of those either.
Right.
I'm not looking at mortgages every day. I'm not a mortgage broker, even though I had a little brokerage back in the day, a little boutique operation when I was in my 20s. But then I realized I couldn't be the best at doing all these different things, and it became a distraction. Right. But at least you can kind of understand break-even analysis. Look at that disclosure form. It's going to tell you what all your fees are, right?
Yeah.
From the appraisal fee to the origination fee to a number of things. And a lot of times when people don't charge an origination fee, just make sure they have a competitive interest rate. Are you getting the best interest rate? And understanding whether that's right or not. And then you just have to look at your personality. I prefer interest-only loans because when you pay them down, it lowers your payment. And you get to choose how much you pay. Where an amortized loan is giving you principal and interest, but as you see early on in amortization loans, you're paying a lot of interest and less principal. And then over time. But here's the thing. If we're looking at a 30-year period of time, and we're talking economics for just a minute, if you can earn 5% on your money or pay 5%, as you know, there's always an interest cost. You either forfeit the right to earn interest if you pay cash, or you pay someone else interest to keep control of your money.
Yeah.
And so if I have three options where I could pay cash to a 15-year or a 30-year, but it's all the same interest rate. I can earn 5 or pay 5. Or maybe in today's world, it's more earn 3 or pay 3. And it's all equal. There's no risk to earning that 3%. There's some assumptions here. Well, whether I pay cash, whether I finance for 30 or 15 years, it's the same interest cost.
Yeah.
That money would have grown at 3% to be the same amount of interest earnings as interest I would pay on a 30-year loan. So, and a 15-year loan, if it was the same interest rate as a 30-year loan, if I paid the 30-year loan with the same payment as a 15-year, it would pay off in 15 years.
Yeah.
So a lot of times in my rudimentary thinking in high school, going in math class, I was like, 15 years saves interest because I didn't understand cost of money, opportunity cost, or what it meant to earn interest. And it takes a different mind than just looking at what I'm paying.
Absolutely.
Versus what I'm giving up in earning.
Yes.
So I'm just trying to help kind of overall look at this.
That's an important part of the conversation. For sure, for people to consider and look at when they're reevaluating, their mortgage and refinancing. My question too is, I'm wondering if someone's refinancing their mortgage and they have this extra cash on hand, instead of putting it in a savings account or a money market, is it valuable to push that money to a cash flow banking policy?
Yes, because if you're only paying 3%, which the interest only I was working on was 3.125%, my cash value policies have done better than 3.125%. After 5 years. Now, the first 5 years, there's costs and it takes time to kind of get to break even. So you have to really look at like what your time frame is because you might be ahead by just sending the money in a savings account for the first few years. But then you're paying tax on that. You're not earning a lot. You're not getting the benefits of a death benefit. And then after, 5, 6, 7 years when it's designed properly, now it crosses over. When I get to 10 years, I might be 400% ahead. When I get to 20 years, I might be 800% ahead as far as my returns. So that's kind of the thing to look at. And as long as I'm safe and stable and keeping control of my cash, I like to put that all in cash flow banking, which meets that criteria. And then if I want to pay off a loan, like where we're at right now, I paid this off with my cash value. And then I now pay back my cash value. So. All right. Well, that hopefully answers some of those questions. Good questions around cash flow banking. You can check it out. Go to cashflowbanking.com. Set up an appointment. They can analyze what would happen if you just put money into a mortgage to try to pay it off quick, or if you refinance, and then what the fees are and what it would look like if you set it into cash flow banking, and which one would be your safest, most stable, and most efficient plan to getting these things paid off. Want to continue the path to be a better investor? Make sure that you're not losing money and taking too much risk? Well, click here and learn about strengths vesting.